Hello and welcome to video number 11 in the series. We're going to talk about two new numbers, concepts that you can use for tweaking your system, similar to this last video with the R multiple and the profit factor. They're not numbers that you necessarily need for your system to work, but they are useful for kind of analyzing your system and seeing where you can improve. So first off, what do these things mean? The MAE is your maximum adverse excursion. Your MFE is your maximum favorable excursion. I think this is one of the weirdest named concepts in trading. When I think of excursions, I think of like hiking or going on an adventure, but that's what they're called, and they are pretty literal. So what they are, just to draw a couple examples here. Let's say you had a trade that kind of went up and down like this and hit your stop loss, right? This is your take profit. This is your stop loss. This is where you entered. And let's say you had another trade, your entry, take profit, stop loss, kind of similar deal, kind of went up and down and then ended up hitting your take profit, right? This would be a winning trade. This would be a losing trade. So your MAE is measuring the distance between where you entered and when you exited, how much the price went against you. So you entered here and the price went against you this much. The MFE is how much it went in your favor. So you entered here and the price went to about there, right? Whatever that number was, it'd be that distance. On the winning trade, the MFE, you entered here, got out here. The MAE, that would be your lowest point there. So it would be a measurement of that distance. So, okay, you might notice a couple things there. Every time you lose a trade, if your stop loss is fixed, right, if you're not moving your stop loss around, your MAE is always going to be the distance between your entry and your stop loss, right? So let's say in this example, we're using a stop loss where we lose, I don't know, $10 and a take profit where we win $20. So in this case, our MAE would be 10, right? We lost 10 bucks. And every single trade we lose would have that. On this trade where we win, all of our MFE would be $20, right? Because every time we win, it's hitting our take profit. So the most that it went in our favor was our take profit, obviously, right? So how do you use these numbers in an effective way? You sort of flip the switch a little bit. You use your MFE for your losing trades and your MAE for your winning trades, because as you see here, that is actually a number that's going to change, right? Your MFE on this trade would depend how much it went in your favor before you lost. So you get different numbers. And your MAE would be different on your winning trades, right? How much did it go against you before you won? We talked about people who don't use take profits, who just kind of raise their stop as it goes. So in those cases, you would get different amounts on a winning trade. But just for simplicity's sake, let's just pretend that you have a hard stop and a hard loss. So how do you measure these distances? What number do you use? What calculation? So I think the most common, and I think the guy who created the concept used ticks. So a tick is just, the smallest amount of movement on a chart. So if you're trading something that's in dollars, a $1 move might be the minimum. So you would say this moved $20, $10, whatever, or maybe cents. It could be pips if you're trading Forex, or if you're trading against like Bitcoin, it could be like Satoshis. Pretty much how many like little ticks it moved against you. You could trade based on your P&L, like your profit and loss, which is kind of what I was doing here. Like how much money I would have made if I sold there versus how much I lost down here. How much money your trade is winning versus losing during the trade. You can do it by a percentage, right? You could say the price moved up 4% before dropping to my stop loss. It went down 3% before going up. One way I think is pretty useful is doing it by your R value, your risk. We talked about it in the last video. So you could say, if my risk here is, $10, that equals 1 R, right? You could say it went up half of an R against me, like 0.5 R. Or it went against me 0.2 R before it went up, right? Because then it's always going to be relative to your risk, and not because sometimes you're trading charts that are more volatile with bigger swings, smaller swings. Maybe you're trading different account sizes, things like that. This doing it by risk actually might be the best way to contextualize it. Some people actually make like one that's weighted by volatility, like they use the ATR the ATR indicator, which is the true range, which measures the volatility. So they'll say, what was the ATR at the time of the trade? And then it can get complicated. For now, I'm just going to do it by the P&L method, just like how much you would have won, how much you would have lost, right? Just to keep it simple. Okay, so that's the basics. Let's do some examples. I'm going to draw like 3 different trades. And these are going to be my take profits and my stop losses, right? Okay, so these are all going to be winning trades. So let's say this price kind of went like this, and I hit my take profit. This one, I went down here. This one had a little dip and then immediately went back up, right? So all 3 of these are winning trades. They all hit my take profit eventually, which means that the MFE, if I'm doing the same numbers as up here, that would be 10. This would be 10, that would be 20. All of the MFEs would be 20. So it's not giving me anything super interesting there. But like I said, for the winning trades, we should use the MAE as an interesting data point. So let's say down here, the price went against me, I don't know, let's say $4. And let's say on this one, the more it went against me was 6. And this one, maybe 5, right? So what does that tell you? That on these trades, you could have set a stop loss at 7, right? Like your stop loss could have gone from here to like here, right? And you would have still won all of these trades, right? Because it wouldn't have hit that stop loss. So why is that good? Well, if you're decreasing the size of your stop loss, the distance to your stop loss, that means when you lose a trade, you're losing less money. So in this 10 to 20 example, that would be a 1 to 2 risk reward, right? But so that would be 10 to 20 equals 1 to 2, but now you're going 7 to 20. So to calculate that, what would that be? That'd be 1 divided by 0.7 is 1.42. So you would go 2 times 1.42. Pretty sure that's correct. So your risk reward ratio is now 1 to 2.84, right? If you have a 7 to 20, it comes out to 1 to 2.84. You could double check that math, but it's probably something along those lines. So that's an increase in your risk reward ratio. You just improved your risk reward ratio, which is great. That means you're risking less money to make more money. So let's do the flip side of that and see how we can use it for the MFE. I'm going to do the same. 3 trades. And these are trades where we lost. So these are trades that kind of went up and then I lost. This one, up and I lost. This one, same, up and lost. Usually you want to be looking for trades where the price, got close to your stop loss or close to your take profits, because like if the price just went straight up, you wouldn't say, I'm going to put my stop loss at 1, right? No, usually you want it to be like a small tweak. So in these examples, I'm kind of using stuff that got near the stop loss or take profit, but didn't exactly hit it. So here, let's say we got we're going up for 20, right? And that's down to 10. So let's say this got to like 18, 16, 17. So they all got pretty close, but they ended up losing. So what you can do here is the reverse of what you did here. You can say, well, if I had my take profit at 16, right, I would have won all of these trades. So in the future, you could go for a lower take profit, and what will happen is you'll end up winning more trades. So in this example, what happened was you were increasing your risk reward. What would happen in this example is you would be increasing your win percentage, right? Because you're winning more trades that you would have lost. So your win percentage is going to go up. So that's the pro side, right? You can increase your risk reward, you can increase your win percentage, but there's a con, right? There's a flip side to this. So as an example, let's say you had another trade here that you won, right? But this one got all the way down to like 9, right? So if you had raised your stop loss to 7, normally it would have gone up and given you a winner. But now, because you set your stop loss to 7, that one would have lost. So what's going to happen is, as your risk reward goes up, your win percentage is going to go down, right? You're going to win less trades as you squeeze your stop loss up, because these ones that would have maybe had that wiggle room no longer have it. the same is true over here. Yes, your win percentage is going up, but your risk reward is going down because now your winners are smaller. You're getting smaller wins, right? You used to have a 1 to 2. Now, if you put your take profit at 16, that would be a 1 to 1.6, right? So there is a pro and a con to each one. And to kind of illustrate the downside, let's pretend we're doing 30 trades. And let's say we won 20 and we lost 10. This is with the original take profit and stop loss, the 10 and 20, before we adjusted anything. So if we won 20 and we lost 10, that would be a 20 divided by 30 is a 66% win rate, right? And we're winning $20 and losing $10. So 20 winners times $20 is $400. 10 losers times $10 is $100. And that means we profited $300, okay? So now we adjust our stop loss. We bring it up to 7. We change our risk reward. So now when we lose 7. We win, we still win 20. But let's say out of those 30 trades, let's say we had 2 that were like this, where now that the new stop loss ends up actually being a bad thing because it stops us from getting a winner. So we end up only winning 18, right? And that means we lost 12, right? Because when you decrease your winners, you're also increasing your losers, right? So you got 2 less wins, 2 more losses. So let's do that. So 18, the winnings are the same, $20 each time. You win $360. And you have 12 losses. Now your losses are smaller. They're only $7 now. And you get $84 in your losses. And then 360 minus 84 equals 276. So you still made money, right? This is still a positive number. But you're making less than you were before. So in this case, you increased your risk reward, but because your win percentage dropped, you actually are worse off than you were before, right? So on this one, your win percentage ended up being 60%. So just to illustrate that the win percentage dropped, if your win percentage was like higher, if it was like 80 and then dropped to like 75, maybe this would have ended up as a bigger number. If your risk reward started at higher up and you increased it even more, maybe that increase in risk reward would have countered the win percentage. It really depends. If you would have raised your stop loss from 10 to 5, not 7, then your losses would have been even smaller. There are lots of variables at play, but the point is that it's not necessarily always good to raise your stop loss. The MAE and MFE are there to kind of guide you and give you some data points to experiment with. So the next thing I want to talk about is sort of, doesn't really have a name. I like to call it your max take profit and your max stop loss. And the reason it doesn't really have a name and there's not an official way to call it is because there's no official way to calculate it. What I'm talking about is, let's say you have a trade that started here and it went up and then kept going up and then did like that. How could you know if there was a way to increase your take profit, right? Because over here, what we're talking about is getting your take profit and getting your stop loss and kind of squeezing them, right? You're bringing your stop loss up, you're bringing your take profit down. You're squeezing the distance. Well, what if you want to expand it? Okay, so in this case, you wanted to put your take profit higher. Or what if there was a trade where, the price kind of went down and peaked below your stop loss and then went up? And you want to say, well, what if I could have put my stop loss lower? So I like to measure that as well. The reason why it's not like an official thing, why it's sort of arbitrary, is because what number do you put? With the MAE, it started where you entered and it ended where you exited. That's it. Like there's no subjectivity there. It's like it went down a certain amount, whether it's ticks, risk, whatever. It's an absolute amount. This becomes, where do you draw the line? Is it there? Is it up here? Because let me give you another example for like a winning trade. Let's say the price kind of went up there and then kind of hung out for a little while and then went up more. What would be your max take profit there? is it up here? Is it there? Where could you have let it ride to? Maybe it goes up forever. It never comes back down. So you could say my max take profit could have been, $1 million. I like to kind of use my signal to say, okay, well, this was the move that got me to my take profit. So maybe that's the move that I could have taken advantage of, So it's a little more subjective in that way. The same goes for losses. If the price kind of goes down here and then does this for a long time and then goes back up, you said, oh, I could have put my stop loss down here. That's really far away. Is that even useful for me? So it is a little subjective thing. The other thing is it does require time, because when you get out of a trade right here, right, you don't know how high it's going to go. You kind of have to wait. So depending on what kind of chart, what time frame, you have to come back and check on it, a few hours later, a few days later, and kind of see what happened post. So lastly, we're going to talk about one last number, which is your E ratio, which means your edge ratio. What it's going to do is it's going to measure the distance between your MFE and your MAE. And the way it's going to do that, so let's use these same $10, $20 examples. Let's say I'm going to list all my MAEs here, and my MFEs over here. Okay, so let's say we won 3 trades, so those 3 trades would have a 20 MFE, right? And on the first one, let's say it went against me 4. And on this one, let's say it went against me 6. And on this one, let's say it went against me 2. All right. And then I had 2 losing trades, which when I lose, it's always a 10. So I lost those 2. I would put more, but I ran out of page. And let's say on this one, it went in my favor 4, and then I lost. And this one, it went in my favor 12. And I lost, right? Because my take profit's 20, so it didn't quite get there. So then your E ratio is just your MFE divided by your MAE. So this would be 20 divided by 4 equals 5. This is 20 divided by 6 equals 3.3. 20 divided by 2 is 10, obviously. I don't need a calculator for that. 4 divided by 10 is 0.4. 12 divided by 10 is 10. Wait, no. 12 divided by 10 is 1.2. The first thing you should know is these numbers are arbitrary. Obviously, it depends on which numbers you use here. If you're using percentages, profits and loss, ticks, whatever, they're in the context of whatever you're using. But what it does tell you is which one of your trades used your edge in the best way. So to clarify that, if you're buying a chart that looks like this and you want to buy this dip, you want to try to get the very, 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 very bottom of the dip, right? You want to get the very last dollar on that drop. Now, obviously, that's difficult to do, and usually there's going to be some amount that the price goes against you. But if you look at a trade like this one has your highest E, you won, and it barely went against you, only went against you at 2. Versus this one, which has a lower E, it went against you 6. And on the trades where you lost, this one actually went in your favor 12, so it's not that bad. This one is, out of all 5 of them, your worst one, right? That one only went in your favor 4. So what you can do there is say, okay, the trades where I did really well, I can go back and analyze them, right? I can go look at a screenshot of them or something and say, what was better about those trades? What was better about that setup, right? And obviously that depends on how you're trading, whatever it is, whatever indicator, whatever you're using. You can say, well, this time the indicator was more steep, or it was coming off of a downtrend or whatever. You can analyze it in that way. And then you can look at this one, which was your worst one, and say, okay, what separates this one from that one? What was happening in the charts? What was happening in the markets? So this number kind of can tell you which of your trades the edge was working at its best. You can also kind of find an average amount of all this, so you can say my E has been increasing from this week to the next week to the next, or it's been going down, which means my edge has been getting worse, which means I'm getting in at the wrong places. In general, all of this stuff, there's a lot of numbers to crunch here. It's all a little arbitrary sometimes, so it can lead to what they call analysis paralysis, where you're just analyzing so much that you never actually accomplish anything. Like we showed here, raising your stop loss has a downside, so it is just something you should use as a tool to analyze, but I don't think it's something you necessarily like need to, kill yourself over. It's just an extra tool to have in the toolbox. So that's the end of this video. Thanks for watching. I'll see you at the next one.